Okay, in this area, we're going to talk about LPs, LLCs, and LLPs. First, we're going to begin with a limited partnership. A limited partnership means that there is a requirement in order to have a limited partnership. You have to file a certificate of limited partnership with the Secretary of State's office. That is required. If you do not file a certificate of limited partnership with the Secretary of State's office, no matter what you call it, it is not a limited partnership. With a limited partnership, you have at least one limited partner and at least one general partner. The limited partner actually has a limited say in the daily activities of the business and cannot run the business on a daily basis. The limited partner can act as an employee, a contractor, can give advice to the general partner, and can vote under the revised Uniform Limited Partnership Act. The general partner has unlimited liability with a limited partnership and is treated like a general partner would be in a general partnership. Now, by agreement with a general partnership, if there is no agreement, then you actually have profits are shared equally by partners and losses are shared in the same ratio as profits, or you follow the agreement if you have an agreement. With the limited partnership, in absence of a provision in the certificate agreement, profits and losses are shared based on the percentage of the capital contribution or what is actually contributed. With a limited partnership, again, there is unlimited personal liability for general partners, but limited partners are only limited to what they contribute to the business, whereas with a general partnership, all partners have unlimited liability. General partners are the only ones with a limited partnership that are allowed to take part or participate in the daily management of the limited partnership. The general partner assumes management responsibility for the partnership and has full responsibility for the partnership and all of the debts of the partnership. A limited partner contributes cash or other property and owns an interest in the firm but does not undertake any management duties and is not personally liable for the partnership debt beyond what is actually invested. The formation of a limited partnership is a formal proceeding, and the partners must sign their certificate of limited partnership. The certificate of limited partnership includes the limited partnership's name, the address of the partnership's registered office, the name and business address of its agent for service of process, the name and address of each general partner, the partner's mailing address, and the latest date on which the partnership is to dissolve. If it is not filed, all participants are considered to be general partners. The names of the limited partners are not required in the certificate of limited partnership. General partners, unlike limited partners, are personally responsible for the partnership creditors, and as a result, at least one general partner is necessary in a limited partnership. Limited partners have essentially the same rights as general partners, including the right of access to partnership books and the right to other information regarding the partnership. The liability of limited partners, in contrast to the personal liability of the general partners, the limited partners are only limited again to what they contribute to the business, and limited partners enjoy liability or limited liability so long as they do not participate in the daily management of their business. Also, limited partners' names should not be included in the firm name. So, if a lawsuit is brought against a limited partnership, general partners have unlimited liability. If a lawsuit is brought against in a limited partnership, the limited partners have limited liability. So let's look at an example. Assume a third party brings a $100,000 lawsuit against a limited partnership, and the third party receives a judgment against the limited partnership for the entire $100,000. If the general partner invested $40,000 in the business and the limited partner invested $10,000, the limited partner would only be subject to the limited liability and would only lose $10,000, while the general partner would have unlimited liability and would have to recover the remaining $90,000 from the $100,000 judgment. General partners have the right to take an active part in the business. Limited partners don't have that same right. There are some safe harbor activities under the Revised Uniform Limited Partnership Act, and these are activities that the limited partner can do and remain as a limited partner. One is being a contractor for or an agent or an employee of the limited partnership, consulting with and advising a general partner regarding partnership business, acting as a surety for the limited partnership, and voting on partnership matters such as dissolving and winding up the limited partnership or removing a general partner. Limited partners have the right to a formal accounting of partnership affairs when circumstances are just and reasonable. Limited partners have the same rights as general partners to a dissolution and winding up of the business. Limited partners have the right to reasonable access to the partnership books and to inspect and copy the books. A limited partnership is dissolved in much the same way as an ordinary partnership. Next, a limited liability partnership. With a limited liability partnership, many professionals such as attorneys, accountants, operate in this form of business. This type of form of business ownership provides those businesses that are commonly operated as partnerships limited liability while avoiding double taxation. So all of the partners are limited partners with a limited liability partnership. So there's no general partner. The limited liability partnership means that if another partner is negligent, the partner will not be liable for that partner's negligence. However, the partner will be liable for his own or her own negligence. It does not eliminate liability of your own negligence, or if you were negligent in supervising an employee. It also does not prevent a contract or breach of contract claim between partners. With a limited liability company, they're governed by state LLC statutes. They share the characteristics of a corporation because they have limited liability, and their owners are called members. To form an LLC, you have to have articles of organization. It must be filed with the central state agency, usually the Secretary of State's office. A form of a limited partnership was ruled as being legal in 1988 for tax purposes. It means that the LLC is treated like a partnership as far as tax purposes. The business name must include the words limited liability company or LLC. The owners again are members. Members must report their income personally on the income tax. They have to file articles of organization. Capital contributions can include cash, property, or services. And the articles of organization must contain the name of the LLC, the purpose, the duration, the registered agent, the principal office of the registered agent. The operating agreement of the LLC is equivalent to the bylaws of the corporation. The operating agreement sets forth the specific management authority of members in the LLC. All amendments have to be to this operating agreement have to be unanimous. Profits and losses are shared according to this operating agreement. You have a member managed LLC, which means that each member of the LLC has an equal right in management of the LLC. So all of the members can manage it. Or you can have a manager manage, which means that only those managers, those individuals that are designated as managers, can manage the LLC, and members who are not managers cannot manage the LLC. The advantages of an LLC is you are, as a member, you only lose if there is liability. You only lose what is invested, so you have limited liability. You also can choose to be taxed like a partnership, which would mean no double taxation, or you could choose to be taxed like a corporation. The state's LLCs are not uniform, so those laws will be different. That's a disadvantage.